Welcome back to the deep dive. For the last few years, if you had to pick just one chart, one single line to sort of define the modern market, it'd probably be that relentless climb of companies riding the AI wave.
Oh, absolutely. It's been, well, exponential demand, hasn't it? And no company embodies that sheer velocity better than Nvidia.
Right. Their stock performance, it hasn't just been good. It's been, well, you called it a thrill ride before we started recording, a financial phenomenon, really.
Exactly, a phenomenon. But you know how markets are. After a climb like that, an unprecedented ascent, people get nervous. There's this tension now among investors.
Yeah, I feel that. The big question seems to be, after all these incredible gains, years of them, is the hype finally, getting ahead of the actual reality on the ground?
Are we hitting peak AI? Or is that foundational stuff, the infrastructure, still accelerating? That skepticism, it's palpable. You can really feel it now.
And tackling that skepticism, getting past the noise, that's our mission for this deep dive. We're going to try and sidestep the talking heads, the big product announcements for a bit.
Okay, so what's the plan?
We're diving into the hard data, the really objective financial numbers from arguably the single most critical player in the whole hardware game, Taiwan Semiconductor Manufacturing Company, TSMC.
TSMC. The foundry. That makes perfect sense. They're the ultimate source, aren't they? No software spin, no services angle. They just build the silicon, the actual chips.
The indispensable stuff.
Right. If AI demand was slowing down, if companies were easing up on orders for those super advanced processors, TSMC would be the first to know. It'd show up right there in their order books, wouldn't it?
Exactly. And then in their financial results. So what we're digging into today is a close look, almost a forensic analysis of their recent performance.
And the takeaway seems to be,
well, the source material suggests it's the clearest evidence yet. The most concrete proof that AI adoption isn't just continuing, it's structurally, undeniably picking up speed, accelerating.
so TSMC provides the foundry proof, as you put it, that the revolution is still gaining steam.
That's the idea, the foundry proof.
Okay, I like that. Let's unpack this evidence then. But maybe first, let's quickly set the stage with Nvidia, because understanding that context, that market skepticism, is pretty crucial, right?
Definitely. We have to start there because, honestly, NVIDIA's story is what's driving this whole narrative, this whole debate. Their GPUs, they weren't just, popular for data centers.
No, they became the gold standard, overnight almost, for AI training, for inference. They are literally the engine of this revolution, the central nervous system, you could say.
And that surge in demand for their chips, it translated directly into just massive leaps in revenue, in income, quarter after quarter.
It's like nothing we've seen in modern corporate history, really, the scale.
Yeah.
It just defies the usual comparisons. And this growth, it pushed NVIDIA's market cap past, what was it, $4 trillion?
$4 trillion, yeah. Just pause and think about that number for a second. That made NVIDIA the first company ever to hit that valuation.
Which is just mind-boggling.
Right. And it's a number that kind of forces investors to believe in almost infinite future growth, doesn't it? Doesn't that naturally breed skepticism?
It absolutely does. That's the crucial point. When you hit that kind of exponential, almost gravity-defying success, the market immediately starts poking around, looking for cracks.
The narrative shifts.
Exactly. After years of just relentless gains, investors quite reasonably start asking, okay, can this really keep going? It's not irrational. It's almost a necessary check when you see valuations like that.
So the big question being asked now is the excitement, the hype maybe, is it outpacing the actual real-world deployment, the sustained use of the tech?
Are companies just buying chips ahead of need? Building inventory maybe? Is the actual usage cashing up?
That uncertainty, that's the source of the anxiety we're talking about.
Precisely. People need proof. Tangible proof that adoption isn't just happening, but that it's going to keep fueling more growth, not just next quarter, but for the next few years. It's like the skepticism test.
The skepticism test. I like it. And that test is exactly why we need to turn to TSMC, because they're the ultimate barometer, right? They're separate from the marketing hype of Nvidia or the cloud guys.
That's exactly right. Think of them as maybe the gatekeeper.
Yeah.
Or like the toll booth operator on the tech highway. They get the orders for the physical chips months ahead.
So if orders for advanced AI silicon were drying up, if those huge capacity commitments were being scaled back,
TSMC would see it first. They'd feel it first. Lower capacity utilization may be guiding down expectations. They hold the objective numbers.
the foundational numbers that either prove the AI spending story is real or Well, completely invalidate it.
So the data we're about to look at, it's like the definitive stress test for all that market skepticism.
Okay, let's get into it. The proof, the numbers, TSMC's recent results.
Right. Let's look at the evidence. Because their third quarter results, they weren't just they were a complete demolition job on Wall Street consensus estimates.
Proof positive, as the source material puts it. Evidence that the AI revolution is still gaining ground, not peaking.
Absolutely. And fundamentally refuting that skepticism we just talked about.
So let's start at the top. Revenue. What were the specific figures? How badly did they crush expectations?
Okay, so TSMC reported revenue of NT $989.9 billion for the quarter. Now, converting that to US dollars, that's roughly $33.1 billion total revenue.
33.1 billion. And what were analysts expecting?
The consensus was calling for something closer to $32 billion. So, they didn't just meet expectations, they comfortably beat even the high end of the estimates.
Okay, beating by over $1 billion is significant. But you mentioned something earlier about the currency effect making it look even better in US dollars.
Oh, yes, that's a really crucial point and something the initial headlines might have glossed over. The year-over-year growth was 30% when measured in their local currency, new Taiwan dollars.
30%. Still very strong.
Very strong. But measured in US dollars, that same growth was an even more astonishing 41% year-over-year jump.
Wow, 41%. Why the big difference? How does that work?
It's all down to global currency movements. During that period, the US dollar was relatively strong compared to the new Taiwan dollar. Since TSMC sells globally but reports locally, when they translated those strong NT dollar earnings back into the globally traded US dollar,
The number got magnified.
exactly, the strong dollar acted like a tailwind. So it wasn't just high demand, they were also getting sort of a bonus return when converting those earnings back. It adds another layer of financial strength, boosts their margins even more.
That's fascinating. So a currency tailwind amplifying what was already a super strong demand signal. Okay, so revenue beat estimates boosted by currency. But what about profitability? That often tells a deeper story, right? Efficiency, pricing power.
And the profitability story is arguably even more compelling than the revenue beat. They reported earnings per share, EPS, of NT $17.44. Now, for U.S. investors, that translates to $2.92 per ADR, the American Depositary Receipt.
$2.92 per share. How does that compare year over year?
That figure was up a massive 39% compared to the same quarter last year. 39% earnings growth.
Okay, hang on. Let me contrast that again. If analysts expected around $32 billion in revenue, what were they projecting for earnings per share?
This is where it gets really impressive. The consensus estimate from analysts was calling for EPS of $1.95.
$1.95.
$1.95. TSMC delivered $2.92.
Wait, that's a 50% beat on the bottom line. How is that even possible if revenue only grew 30 or 41%?
Right. It's a truly massive outperformance. It points to incredible execution, really tight cost control, but most importantly, incredibly strong margins on their most advanced products.
The AI accelerators.
Exactly, the AI chips.
So digging into that profitability jump, their CFO, Wendell Huang, he mentioned cost improvements, but he mainly pointed to demand, right?
He did. He attributed the results partly to cost improvements, sure, but primarily he said it was due to strong demand for our leading-edge process technologies.
Leading-edge process technologies, and the source material basically says read.ai.
Pretty much, yeah. We should probably unpack what leading edge really means here because it's key. We're talking about the most complex chips they make, the ones fabricated using their 3-nanometer and 5-nanometer nodes.
Right, the nanometer nodes. Can you just quickly remind us what that number signifies and why it's so crucial for AI and for TSMC's margins?
Sure, the nanometer figure, like 3-nanometer or 5-nanometer, it basically refers to the size of the tiniest components, the transistors. They can etch onto the silicon wafer. Smaller number means you can cram vastly more transistors onto a single chip, billions, even hundreds of billions.
More transistors equals more processing power.
Exactly. And crucially for AI, these advanced nodes let you pack in that immense processing power while keeping heat and power consumption manageable. That's the bottleneck in big data centers' power and cooling.
Ah.
TSMC's mastery of these tiny, incredibly complex nodes is what allows, say, an Nvidia GPU to perform those intense AI calculations without, melting down the server rack.
And because making these chips is so difficult, and TSMC is basically the world leader, almost a monopoly at the very cutting edge.
They command premium pricing. Huge margins. That's why the earnings per share, the profitability, leaped so far ahead of the already strong revenue growth. It's the high-margin product mix effect.
Okay, that makes sense. So it's not just generic chip demand driving this, it's specifically demand for the most advanced, most powerful, and most expensive chips they make.
Precisely. And to really nail this down, to confirm the AI thesis, we need to look at where the money came from within TSMC's business segments.
Right. Break it down.
Okay, so TSMC reports across several areas, but the one we really care about here is high-performance computing, or HPC. That segment includes the processors, the accelerators used in supercomputing, data centers,
Okay.
essentially where all the AI demand resides.
And what did the HPC segment do?
This is the kicker. The HPC segment surged. Wait for it. 57% year over year.
57%.
57%.
Wow. Okay. That number alone. That really ought to quiet down some of that skepticism about peaking demand, shouldn't it?
You'd think so. It's an extraordinary level of growth, especially when you compare it to their other major segments.
Like smartphones, how did that do?
Well, the smartphone processor segment, which is historically a massive part of their business, it also had a good quarter, showed a healthy rebound, actually. Revenue for smartphones jumped 30%.
30% is still great growth for a mature market like smartphones.
Absolutely. But context is key here. Even that really robust 30% growth in smartphones just pales next to the 57% explosion they saw in HPC.
So the part of their business directly feeding the AI boom is growing almost twice as fast as their huge consumer electronics business.
Exactly. It's that disproportionate growth. It clearly shows AI isn't just, a driver. It's the overwhelming, accelerating force behind these phenomenal results.
And HPC growth, driven by corporate infrastructure spend, is probably more durable than consumer spending cycles too, right?
Generally, yes. Corporate IT budgets, especially for something seen as transformative as AI, tend to be stickier, less cyclical than someone deciding whether to upgrade their phone this year.
So the hardware evidence, the actual orders TSMC is fulfilling, seems undeniable. The narrative of slowing AI adoption just doesn't seem to hold up against this foundational data.
It really doesn't. The numbers tell a very different story, a story of acceleration.
Okay, so that's a look back at Q3, blockbuster results driven by AI, but markets are always looking forward. What did TSMC say about the road ahead? Did they signal any nervousness, or did they double down?
They absolutely doubled down. Management didn't just report a great Q3. They gave a really strong boost to their forecast for the next quarter, Q4. That outlook, maybe even more than the Q3 results, directly contradicts the market's skepticism.
Okay, let's get the details on that Q4 outlook boost. What are they forecasting now?
For the fourth quarter, they're guiding for revenue of $32.8 billion, right at the midpoint of their guidance range.
$32.8 billion. How does that compare to last year's Q4?
That represents an expected increase of 24% compared to the prior year quarter. Still very strong growth on a tough comparison.
24% growth expected. And again, what were the analysts thinking before this guidance came out?
The previous analyst consensus, which is already pretty bullish, mind you, was anticipating Q4 revenue of around $31.5 billion.
So TSMC guided significantly higher than even the already optimistic analysts. They raised the bar again.
They did. It reinforces that key takeaway. The actual pace of AI growth keeps surprising to the upside. It's outpacing even the most robust external forecasts.
And these forecasts from TSMC, they aren't just based on vibes, right? They're based on actual orders and commitments.
Oh, absolutely. This isn't spreadsheet guesswork. It's based on direct conversations, long-term capacity reservations, confirmed purchase orders, multi-year supply agreements with their biggest customers, the Nvidias, the Apples, the cloud providers of the world.
And did the leadership offer any sort of qualitative comments about the demand signals they're seeing?
Yes, CEO C.C. Wei was very clear on the earnings call. He specifically noted that TSMC continues to see very strong signals from their customers.
Very strong signals. That's pretty unambiguous.
It is. And remember, these signals are derived from those long-term commitments, things that are hard to cancel or walk back quickly. The implication is clear. They expect demand for these AI-focused chips to keep accelerating well into next year. They see no sign of a plateau based on what their customers are telling them and, more importantly, committing to.
Okay, strong Q3, strong Q4 guidance, strong customer signals. This brings us to maybe the most powerful signal of all, where they're putting their own money, their investment strategy, capital expenditures, CapEx.
Exactly. Companies don't make massive multi-billion-dollar bets on new factories unless they are extremely confident that the demand will be there for years to come. And building a leading-edge semiconductor fab, it's one of the most complex, most capital-intensive things a company can do.
We're talking tens of billions of dollars, years of construction, huge long-term commitments.
Astronomical investments with very long payback periods. And TSMC is continuing to invest heavily, pouring billions into developing and building capacity for those leading-edge nodes, the 3 nanometer, the upcoming 2 nanometer, and beyond.
And this investment is specifically targeted at AI demand.
Overwhelmingly, yes. It's aimed squarely at building the sheer capacity needed to meet this ongoing growing demand for the advanced chips that power AI systems. They are making a colossal, multi-decade bet on the future of AI silicon.
They wouldn't risk that kind of capital if they thought the current demand was just a temporary blip or an inventory buildup.
Absolutely not. The fact that the CapEx continues at such a high level is maybe the strongest proof that they believe the projected returns, especially from those high-margin AI chips, are massive enough to justify the spending. They're literally building the physical foundation for the next decade of AI.
It reinforces that the demand signals they're seeing aren't just strong. They believe they're structurally sound and incredibly long-lasting. It's the ultimate form of external validation, isn't it? Putting your own billions on the line based on those customer orders.
I couldn't have said it better myself. It's the highest form of validation you can get.
Okay, so if we connect all these dots now, the huge Q3 beat, the raised Q4 guidance, the very strong signals, the massive ongoing CapEx, the 57% HPC surge, what does this all mean for Nvidia and the broader AI market?
Well, the implications for Nvidia seem pretty immediate and profoundly positive, don't they? It essentially validates their growth story and, to a large extent, their current valuation.
Because that surging demand for the most complex leading-edge chips at TSMC, it translates almost directly into more growth for Nvidia, given their position.
Exactly. Since Nvidia's GPUs are the gold standard for AI processing and TSMC is the primary manufacturer of those GPUs, when TSMC reports a 57% surge in HPC chip demand.
A huge chunk of that has to be Nvidia chip.
A dominant chunk. We actually have hard data on Nvidia's market share to back this up. According to IoT Analytics, Nvidia controls something like 92% of the data center GPU market.
92%. That's near total dominance.
It is. So think about it. When TSMC's HPC segment grows by 57%, effectively 92 cents of every new dollar spent in that segment is flowing through Nvidia. It's an incredibly direct link.
Okay, but hang on. If they already have 92% market share, isn't that almost a problem? Like, where does the next big phase of growth come from if you already own practically the entire market? That feels like a valid point for the skeptics.
That's an excellent critical question. And the answer isn't really about gaining more market share, although they might pick up bits here and there. It's about the entire market expanding rapidly.
Market expansion, not just share gain.
Precisely. Nvidia is benefiting so tremendously, not just because they're beating competitors, but because the total addressable market, the whole pie, is just exploding in size.
And Jensen Huang, Nvidia's CEO, he put some numbers on that potential market expansion, didn't he?
He did. He offered this massive projection that really helps frame the current growth within a much longer-term opportunity.
What was the forecast? Give us the scale of that vision.
Huang projected that total spending on data center infrastructure, driven overwhelmingly by the shift to AI, is expected to reach somewhere between $3 trillion and $4 trillion annually by the year 2030.
$3 to $4 trillion annually?
Annually, by 2030.
It's hard to even comprehend that scale. That's larger than the entire GDP of many major countries.
That's astronomical.
Yeah.
But that's the scale of the opportunity that TSMC's current growth seems to be validating the very beginning of.
Yeah.
That 57% HPC surge we saw. That's just the initial explosive phase of this potentially colossal long-term shift in IT spending.
The current demand is like the down payment on that multi-trillion-dollar future.
Well put. And what's really crucial now for understanding if that future is likely is looking at where the demand is coming from, because that tells you about the maturity and the resilience of the AI market.
Okay. So initially, it was mainly the giants, right? The hyperscalers.
Exactly. In the beginning, a lot of the demand was concentrated among a few huge players, the big cloud providers, who needed massive compute power to build those foundational large language models, the LLMs.
We're talking Amazon Web Services, Microsoft Azure, Google Cloud, maybe Meta platforms, the big 4 or 5. They have deep pockets and the need to train these enormous models.
Right. But the source material we looked at highlights a really vital shift. It confirms that demand is now beginning to move downstream.
Moving downstream, what does that mean in practical terms?
It means AI adoption is broadening out. It's not just those initial cloud behemoths anymore.
Yeah.
Now you're seeing additional enterprises, maybe mid-sized companies, specialized startups, even governments starting to adopt AI integrate it into their operations.
So it's moving from being just a tool for a few tech giants to becoming more of an enterprise necessity across different industries.
Precisely. And that shift is critical. It's what potentially turns a boon concentrated in a few customers into a much broader, more sustainable structural revolution.
And this downstream adoption, it de-risks the growth story for Nvidia and TSMC because it's not reliant on just 4 or 5 buyers anymore.
Exactly. And these new enterprises, they're looking to benefit from AI in two main ways, which drives different kinds of chip demand. We should probably clarify the difference between AI training and AI inference.
Good idea. So
Training is the heavy lifting part. It's the process of actually teaching the AI model,
Mhm.
like building that foundational LLM. It requires immense concentrated computing power, often over a long period. That's what drove the initial wave of demand, mostly from those big cloud players.
Okay, and inference.
Inference is when you actually use the trained model to do something useful, to deliver value in real time. Running the model in production to answer a question, generate code, analyze an image, predict a stock price, whatever it might be.
So training is building the brain. Inference is the brain thinking and doing things.
That's a good analogy. And inference demand is different. It tends to be more volume-based, more distributed across many users and applications, and it's continuous. Think about specialized AI models for legal research or medical diagnosis, or thousands of e-commerce sites using AI for recommendations, or factories using AI for quality control.
Right. Lots and lots of smaller ongoing uses rather than one massive training run.
Exactly. As more and more enterprises adopt AI, the demand for inference chips, which Nvidia also sells and TSMC also builds, just explodes. It creates a much larger, much more diverse, and arguably more resilient and continuous demand base than training alone.
Okay, so that downstream movement combined with the growth of inference is what really underpins that huge $3 to $4 trillion projection. It shows AI becoming embedded everywhere.
It suggests a pathway, yes. It shows it's not just reliant on a few massive buyers doing training runs, but potentially integrating into the fabric of the entire economy via continuous inference demand.
Makes sense. Okay, so given all this foundational hardware demand confirmed by TSMC, let's circle back quickly to NVIDIA's valuation itself. The stock, as we said, up over 1,100% since early 2023. That kind of run always raises questions.
Always. Is the stock price getting ahead of itself? Even if the business is great, is it too great, already priced in?
Right. Is it priced for perfection? What do the numbers say now, considering this growth outlook?
Well, the source material we reviewed cited NVIDIA's stock selling for about 28 times next year's expected earnings, a forward PE ratio of 28.
28. Now, objectively, that's still a premium compared to the broader market, or like older tech companies.
It definitely is. But you have to judge that premium against the expected growth rate. And this is where the TSMC data provides that crucial underpinning, that validation.
So what's the growth expectation that supposedly justifies that 28 times multiple?
According to the source, the market expects Nvidia to grow its revenue by roughly 26% annually over the next 5 years.
26% compound annual growth for 5 years.
That's the expectation baked into the price. So you're looking at a company trading at 28 times forward earnings, but expected to grow revenues at 26% per year. And that growth is being actively validated right now by the foundational orders flowing through TSMC.
So if you look at something like the PEG ratio, price earnings to growth, a 28x multiple on 26% growth puts it around 1.1 or so, which isn't actually that outrageous for a market leader in a booming sector.
Exactly.
It suggests the market isn't necessarily pricing in impossible perfection, but rather accurately reflecting massive multi-year expansion potential, an expansion supported by the foundry proof we've been discussing. The valuation seems less like hype and more like a rational response if you believe the underlying hardware demand story confirmed by TSMC.
The physical reality of silicon orders, the billions in capex, that's what makes the difference between just hype and potentially sustained real growth.
It's the tangible evidence.
Okay, let's try and wrap this up then. Let's synthesize the key takeaway for you, the listener, from this deep dive.
I think the core point is this. TSMC's actual financial results, the way they demolished consensus estimates, the raised guidance for the future, and especially that incredible 57% surge in their AI-heavy HPC segment, it all provides really clear, really objective evidence straight from the manufacturing front lines.
And this evidence, this foundry proof, it acts as a powerful counterargument to that narrative we talked about, the idea that AI adoption might be slowing down or hitting some kind of peak.
Right. It suggests the opposite is true.
You now have the context, the hard data, to understand that AI adoption seems to be accelerating, driven by fundamental high-margin hardware demand. And that's confirmed by the company that actually builds the indispensable chips.
It points towards a massive structural and potentially very long-term shift in how data centers are built and what powers them. This deep dive hopefully gives you that objective foundational data to help you navigate the ongoing AI investment conversation. The infrastructure seems solid.
For now, yes, the foundation looks strong.
But if TSMC keeps pouring billions into new capacity and those customer demand signals truly remain very strong, as their CEO said, it does leave us with a final provocative thought, something building on that idea of downstream adoption.
Which is?
Well, we know the big cloud providers kick things off, mostly focused on training those huge models. But if this next wave really is moving downstream to potentially thousands of other companies across all sorts of industries, what are they actually doing with AI?
Right. What are the specific, maybe novel, highly specialized AI applications that these new enterprises are investing in? Especially for inference. Is it in finance, logistics, maybe drug discovery, advanced manufacturing? Something else entirely.
Exactly. What are those killer apps beyond the initial LLM hype that will fuel the next phase of that massive $3 to $4 trillion spending projection? Understanding those emerging applications, the ones driving inference demand across the broader economy.
That will be key to figuring out just how big this AI revolution can truly get and how long this hardware boom can continue.
A great question for you to explore as you connect these dots in your own analysis. That's all the time we have for this deep dive. We'll talk to you next time.